We're nowhere near getting back to 2%. As I said, this is a fantasy. Nobody is willing to accept the fact that those days are long over. In fact, it was a miracle that they ever happened in the first place.
In today's video, Peter Schiff, founder, CEO and global strategist of Euro-Pacific Capital, gives a warning that the 2008 crisis was just the prelude to a larger sovereign debt crisis in the United States that may lead to a collapse of the US dollar.
One of the reasons that this is so important is everybody is hoping that the Fed's war on inflation is working, that all these rate hikes are taking a toll, and that inflation is going to come down to 2%. Well, this consumer credit number, and this is one of the biggest numbers we've had in a while. I think it was like the second biggest jump in credit card debt that we've had. If you're getting this big jump in consumer credit, that shows you that the Fed is losing the inflation war. Because, and I've said this on this podcast before, the way rising interest rates are supposed to fight inflation is by making it more expensive for consumers to borrow money. And if they can't borrow as much money, well, then they have to borrow less. And if they're borrowing less, they're buying less. So spending comes down. Demand comes down because credit is more expensive and therefore less available. So consumers borrow less, they spend less. That reduction in demand helps bring down prices. Well, what do these numbers tell us? That's not happening. Yes, the Fed is raising interest rates, but that's not stopping the consumer from continuing to borrow and spend. So that means that these rate hikes are not nearly enough to get the job done. And one of the reasons for that is that interest rates are still negative. So it still makes sense to borrow money if the rate you're borrowing at is less than the inflation rate. Now, I know like people who are buying on their credit cards, and they're paying 20% interest. I mean, that's way above the inflation rate, but they're still borrowing, right? None of this has worked. None of this has stopped people from using their credit cards. If the Fed wants to make headway in fighting inflation, people have to leave those credit cards in their wallets. They have to stop buying stuff on credit, right? That's the demand. Inflation, it's not just money supply, but credit. It's an expansion of credit, and credit continues to expand. And what does that do? That drives up prices. We need credit to contract. That's what we need. That's not happening. And this whole idea, and I've mentioned this before, people keep saying the way the Fed is supposed to fight demand is cause people to lose their jobs, right? We want people to be unemployed so they stop spending. Look, you can be unemployed and keep spending, right? Because people get unemployment benefits when they're unemployed. They spend that. They don't lose their credit cards. Your credit card company doesn't take your credit card away when you're unemployed. In fact, you probably use it more when you're unemployed because your unemployment benefits are lower than what your paycheck used to be. So you use your credit card more. So people keep spending when they lose their jobs. So that's not going to do it. And I've said many times, the last thing we want is for people to stop working. Because if we have an inflation problem, that means we have too much money and not enough stuff. So we either need less money or more stuff or some combination. One way you get more stuff is if you have more people working, making the stuff. But if people lose their jobs, then there's less stuff because they're not making it. So that means more upward pressure on prices. So if the Fed really wants to fight inflation, the last thing they want is people to be out of work. They want people working. What the Fed wants is the people who are working to stop spending. People have to save. Don't go out and buy stuff. Take what you earn and save it. That's what we need. And the other thing about savings is now that represents money that can be loaned to businesses to invest in capital to produce even more. So we want people working and saving so we can make capital investments so we can grow the economy with more production. That's what would help to bring down prices. We don't want to just throw people out of work so they can keep on spending without producing. And that's what's happening. People are losing their jobs and they still spend. And the people who have their jobs, they don't care about rising interest rates. They're spending anyway. So these numbers show you that there is no progress being made on inflation. Everybody wants to pretend that we're getting closer to the 2% goal. We're nowhere near getting back to 2%. As I said, this is a fantasy. Nobody is willing to accept the fact that those days are long over. In fact, it was a miracle that they ever happened in the first place. I mean, part of it was just the lies inherent in the CPI and all that. But there were a lot of exogenous factors that helped keep the CPI down. One being the low interest rates. Paradoxically, I've talked about that, but 0% interest rates for a while were keeping prices low because companies were able to borrow all this money at zero and they passed on those low interest costs to their customers. And in fact, you had a lot of companies, because credit was so plentiful and interest rates were zero, they could price their products really low or they could give them away. They were losing money and because they didn't care, because they could sell stock because everybody wanted speculative assets in 0% interest rates. So there were all sorts of temporary factors that were allowing that low inflation. It wasn't that the Fed was doing a good job. They were doing a lousy job. They were creating massive amounts of inflation. People want to give the Fed credit. Hey, the Fed really did a good job and they kept inflation below 2%. They did a lousy job. They just got lucky that inflation was 2%. Again, a combination of luck and lies, but they were able to fool people into believing that it was less than 2%. But now it's so bad, they can't fool anybody with that trick anymore. And people just assume that we're going to go back to that. We can't. That wasn't normal. High inflation, that's normal. When you have all this money printing, when you have all this debt, you get high inflation. And in fact, the other thing that's happening now is the de-dollarization, which, pretty much everybody is talking about it. And it's not an accident that they're talking about it. They're talking about it because it's happening. A lot of people don't necessarily comprehend the gravity of what this implies, but it is happening. And this is another reason that inflation is going to be so much higher, because one of the other ways the Fed got lucky and we had such low inflation numbers was because of the dollar's reserve status, because so many of the dollars the Fed was creating were exported and they were hoarded by our trading partners in financial assets. They went into bonds, they went into stocks. So they didn't buy consumer goods. So we had a lot more money, but it wasn't chasing goods. It was chasing financial assets. And that's another reason that stocks did well and bonds did well, because the inflation that we created was used to buy those assets instead of consumer goods. Well, all that is changing and will change as the world de-dollarizes and moves away from the US dollar. So they're not going to need dollars to buy these financial assets. So those prices are going to be coming down, but the prices of goods, the stuff they're going to buy instead, right, that stuff is going to go way up. So this is another thing that's happening, which also brings me to the other data point that came out on Thursday, I think it was, that again gets zero coverage. I don't think anybody even talks about it anymore. And that was the trade deficit, this time for the month of March. And the trade deficit wasn't much worse than expected. I mean, it was worse. I mean, just like the jobs numbers are pretty much always better than expected, the trade deficits are almost always worse. I mean, every once in a while you get one that's lower, but they're pretty much always worse than expected. And even if they're lower than expected, they're still horrific. It's not like they're ever good. It's always a huge negative number. And so for March, they were looking for $63.7 billion deficit. And instead they got 64.2, so a bigger deficit. And in fact, the prior months was notched up just a tenth, but the prior month was a bigger number. It was 70.6 billion. So we did get a reduction in the trade deficit for the month, but it's still an enormous number. And that again is showing you that Americans are continuing to spend, because that's the American spending that is driving those trade deficits, because we're spending money on imports and we see that in the trade deficit. If the Fed really was pursuing a monetary policy that was going to be effective at reducing the inflation rate, you would need to see these trade deficits coming way down, because Americans would have to be responding to the Fed's monetary tightening by spending less. And if we were spending less, well, the trade deficits would be a lot lower. But the fact that we're still running these horrific trade deficits, again, shows that the government is not making any progress. And of course, it's not just the Fed, rather, the government itself, because the government continues to spend money. The in excess of $2 trillion budget deficits continue. Those budget deficits represents additional spending because people who get that money from the government, they're going out and spending it. They're buying all these imported products, right? That's what happens with the budget deficits. This is money that the U.S. government is sending out to Americans that they didn't collect from Americans in taxes. And so there's a big deficit. But what are all these Americans doing with all this money? Well, they're buying stuff with it, right? And so you can see that in the trade deficit. But as long as everybody is spending, we're not going to have a reduction in CPI. Prices are going to keep on rising as a result of all that spending. Now, while I'm on the topic of government spending, the debt ceiling, again, is in the news. And I was reading some quotes online from Janet Yellen, Secretary of the Treasury, talking about this. And you would think, right, if she's the Secretary of the Treasury, her job, in theory, should be to reassure all the bondholders that America is good for its debts, right? We're going to pay our debts, so don't worry, we will do what it takes to pay you, right? I'm the Secretary of the Treasury, and I'm going to make sure that we prioritize our bondholders. They're going to take priority because, that's the full faith and credit of the United States, right? We can't default on that. That would be horrific. So don't worry, about the debt ceiling. We will pay you. We will find a way. We will cut other spending. We'll do something, but we're going to pay. No, that's not what Janet Yellen is saying, right? Here's one quote from Janet Yellen. Quote, "All I want to say is that it's Congress's job to do this," meaning raise the debt ceiling. "If they fail to do it, we will have an economic and financial catastrophe that will be of our own making. And there is no action that the President Biden and the U.S. Treasury can take to prevent this catastrophe." And the catastrophe she is talking about is default on the debt, where the U.S. misses a debt payment. Now, if this is so catastrophic, why don't we just avoid it? Again, I've talked about how much tax revenue we have that's well in excess of the interest payments on the debt. Interest payments are something like $300-400 billion a year. We're collecting 10 times that in taxes, $4 trillion. So we got plenty of tax revenue to pay our debts. But we're not saying we're going to use that tax revenue to pay our debts. No. If we can't borrow more money to pay our debts, then we're not going to pay anything. Again, an admission of a Ponzi scheme. But this is the last thing that you should be saying. I mean, we got people worried about the dollar, worried about the weaponization of the dollar. And we're telling our creditors, you're the low man on the totem pole. It's not really that there's the full faith and credit, because if you own a treasury, the only way you're going to get paid is if we pay everybody else and there's still money left over. Otherwise, you're SOL, right? If we can't go deeper into debt, nobody is saying, right? I haven't heard Janet Yellen or anybody say, you know what, if the Republicans don't raise the debt ceiling, we can't send out the Social Security checks. No, it's all about the debt. The only people who are going to get screwed are the people who own U.S. treasuries. Does that make any sense? Is that what the Secretary of the Treasury should be out there saying? Now, one of the things they're trying to say is that, we're going to use the 14th Amendment or something like that to get around the debt ceiling, because they're saying that, that amendment says that that U.S. debt shall not be questioned. But that's irrelevant to whether or not we have the money to pay. It's not about questioning the legitimacy of the debt. I mean, no one's doing that. Yes, the debt is legitimate. We just don't have any money to pay it, right? So to say that, we have to pay the debt and therefore we can raise the debt ceiling. No, if they want to prioritize the debt, they can do it. In fact, what Congress should be doing right now, and what Biden should be leading the charge, hey, where's the contingency plan? If we don't raise the debt ceiling, what government programs are we going to cut, right? So that we can pay interest on the national debt. What are we going to do, right? Because we have to do something.